Welcome, everyone. Thank you so much for joining us today, because obviously the budget can be quite disruptive, and I think this one has been quite disruptive and given us lots to think about. And I've been speaking to lots of entrepreneurs over the last week to get them really positive about this, actually, because at the end of the day, business is a game. Yes, it's just got a bit tougher, but it's tougher for everyone. So everyone in your industry, it's now just got tougher. And if we can understand the new rules and we can also use them to push on and kick on, then there's also some opportunities here as well. So if I can just introduce who we've got as experts here today. So we've got Andy Hagues from Nuvo, who is the tax associate partner here with over 36 years of experience in tax. But this is the person we want to be talking to understand this budget. So he's absolutely our best friend and should be the most interesting person in the room right now. We've also got Steve Sharp, who is the founder of Nuvo, which has grown from a startup to now a top 100 accountancy firm with a team of 160 people. He's also co-owned several other businesses across hospitality, facilities management, manufacturing, and professional services, employing over 1,000 people. So can give some real life commercial view on the impact of the budget on businesses. And then we've got Dominic, who's a chartered financial planner and has the joy of being my chartered financial planner as well, and owner of Becketts, a national award-winning financial planning and wealth management firm. So with that, I will keep quiet. Andy, can I hand over to you?
So the topics we're going to look at today, there's 6 different ones, but it's the main things which we've picked up from the budget. You've probably seen the headlines for most of these as well. So the first one on there, specifically, it's employers' national insurance. So the changes to employers' national insurance, there was a lot of talk before the budget about what was going to change, and employers' NICs was one of them. And the Chancellor said it's going to increase from 13.8 to 15%. And so it's a big enough increase, 1.2%, and that's from April next year. So the threshold is where the employer starts to pay employers' NIC. And she said this is going to drop from 9,100 to 5,000. And I'm thinking, blimey, that's a £4,100 drop. 4,100 at 15% works out at £615. So what that means to employers is almost every employee instantly from next April, you're paying £615 more employers' national insurance. 100 employees times £615, that's over £60,000 increase. That doesn't take into account the extra 1.2% as well. Employment allowance from 5,000 to 10,500. I've got certain clients I was thinking about. I've got a small engineering firm, probably 4 employees, and straight away I thought they're going to be absolutely fine. You'd need to have around 7 or 8 employees, probably earning around the £30,000 mark, and that's where the change is going to happen. Small employers aren't affected as much by the NIC increase, but what they could be affected by is the national living wage increase. So the national living wage is going up 6.7% next April. That's from £11.44 to £12.21 an hour. So if you've got a small business, and it could be your local cafe, local fly, something like that, they've got a couple of employees on the minimum wage, straight away their staff have got a 6.7% increase in their pay. One thing I saw yesterday in the newspapers, I don't know whether the figures are 100% correct or not, it was going on about Marks and Spencer and Sainsbury's, how many employees they have, how much employers and national insurance they pay. And it said that the two businesses between them could get an increase in their employee costs next year of £200 million. And you think if that's 2 supermarkets paying that much, prices will be going up, which again filters down to employees. The next section we're going to briefly look at is capital gains tax.
Just 1 second, Andy. Just someone's asked a question there. They've just said, except umbrella workers too.
So umbrella workers is you don't work for your client. It's normally because of IR35.
Right.
So you don't work for your end client. You're sort of employed by an umbrella company and you work through the umbrella company for the end client. So capital gains tax. So this was another area where the government mentioned that they were going to look into it, mainly because it wasn't in their manifesto, like income tax, employees, national insurance and VAT. The first thing that was mentioned is that capital gains tax on residences, so this tends to be for second properties, is going to remain at 18% and 24%. The 18% is the gain that's added to your other income that comes in at less than £50,000. So if you've got a job where you earned 30,000 and you've got a capital gain of 20,000, that 20,000 is liable to 18% tax. If it takes you over the 50,000, it's liable to 24% tax. So tax on residences isn't increasing, and it's actually quite surprising. What they did do from budget day is that gains on other assets, which tends to be shares more than anything else, the tax if you're selling other shares, that's being increased immediately from 10% to 18% and 20% to 24%. So it's the same criteria as the other tax rates. You were paying 10% up until your income and the gain hits 50,000 and then 20% above that. But it's actually gone up straight away to 18% and 24%. Your own business is looked at differently, and this is the second point on there, and that's something called business asset disposal relief. It's a form of retirement relief, and we have got clients who are looking at retirement. They're still keeping this business asset disposal relief, and it remains at £1 million. So if you sell your business for £1 million, you pay 10% tax as things stand at the moment, and that £1 million is a lifetime allowance. So you sell your business before April next year, you get £1 million for it, you pay 10% tax. As from April 25, that's going up to 14%. And then as from April 26, that's going up to 18%. So have we got any questions on capital gains tax?
What about property business asset disposal relief for property businesses?
So commercial property, this is one of the losers because commercial property was the 10% and the 20%. Whereas commercial property now is going to be exactly the same as residential property, and that's going to be 18% to 24%. If your business qualifies for business asset disposal relief, that's the 10%, 14% and 18%, but it depends if your business actually qualifies for the business asset disposal relief. There's a few conditions that have to be met there.
Someone's also questioned about what about shares sold in businesses above 1 million?
So shares sold in businesses above £1 million, it's 10% on the first element, depending upon your tax rates, but it's very likely that it's going to be a 24%. So it would have been 20% before the budget on gains above the £1 million, and that will be going up to 24%.
Business asset disposal relief for residential portfolio businesses, landlords, LTD.
So landlords don't tend to get it except in certain circumstances because your business might not be seen to be a business by the tax office. So you have to look at each of those on a case-by-case basis. If you've got a bigger portfolio and you're really hands-on and you're looking after it all yourself, then it could qualify, but it is an area that the tax office really like to get their teeth into because holding properties has been seen as an investment and not a trade. So it will depend upon individual circumstances as to whether you qualify for business asset disposal relief.
Any increase on self-employed NI?
So self-employed NI is remaining the same, much like employees NI. So those rates are okay, and it seemed more like the easiest cash cow was seen to be employers because self-employed national insurance would have been covered the same as employees national insurance in the election manifesto. So they'd have found it difficult to increase it for self-employed as well.
If there is a 4 shareholders in a company and it's sold for 1 million, Is it 1 million relief each?
It's 1 million each, and everybody's got that lifetime allowance.
Does the capital gains tax rate apply to both individuals and companies?
So companies don't really pay capital gains tax. Companies pay corporation tax, which is currently 19 or 25%. If a company does it, it can pay a little bit less. It could do, but then you've got to get your money out of the company afterwards.
Do gains with shares within SIPs and ISAs remain tax-free? What happens to this when a SIP is crystallised?
If it's a SIP, you're better off getting tailored tax advice for that. ISAs are still all tax-free, but SIPs, yeah, you definitely need tax advice relating to your specific conditions there.
I can jump in there as well,
please.
Andy.
Yes,
Yep.
Yeah, just on the SIP side. So internally with an uncrystallised SIP, the gains are still going to be tax-free. And even with a crystallised SIP, for assets that stay inside the SIP, those gains will still be tax-free. But money that you've taken outside of the SIP, once you've crystallised it, your tax-free cash, that comes under the normal rules. And so CGT will apply them.
SSAS, I'm not quite sure what that means. Affected for IHT. Lots of acronyms here.
Yeah, small self-administered schemes are affected for inheritance tax. They're still a defined contribution pension, so the rules are the same. There are nuances to SASs that could be managed around this, but that would be really, really bespoke. And I think the reality is that you've got to see it as being affected for inheritance tax, which I think we'll come on to in a future slide as well.
Thank you. Last question, then we'll move on. What about transferring a SIP into a SAS?
That won't make, no difference whatsoever. They're basically the same vehicle. There's just some slight differences in terms of regulation and what a SAS can do over a SIP. But the effect of CGT or the effect of IHT will be the same in 99.9% of cases.
Can you transfer cash or must be in specie transfer to avoid CGT? We're getting quite specific now.
If that's a pension
from a SIP to a SAS.
SIP to SAS, there won't be any CGT liability. It's just in the assets are ultimately staying within a pension vehicle, and so there won't be any CGT liability moving from a SIP to a SAS.
Okay, thank you. Thank you, guys. Andy, back to you.
So the next slide, inheritance tax revisions. Like capital gains tax, inheritance tax was under the spotlight before the budget. There was loads of talk about changing the lifetime allowance, the residential nil rate band, the rates of tax. There's not been too many changes. The IHT threshold, this is the one that everybody gets, is remaining at 325,000, and that's now until 2030. It's actually been 325,000 since 2009. So by the time we get to 2030, it will have been 21 years where that's not changed. There's changes to agricultural property relief and business property relief, which is where farmers and businesses sell up and retire. There's not going to be any changes until April 26. And then there's going to be a £1 million allowance. So £1 million, you get 100% IHT relief. And any assets above that, you get 50% IHT relief on them. And that's agricultural property relief and business property relief. And then Dom might have... the
main change now is that inherited pensions will be liable to inheritance tax. And so there's still a spousal exemption. So if husband dies, their married partner would receive the pension without an IHT liability. But on the second death, there would be an IHT liability for the estate. The value of that pension will be included for both the IHT calculation, but also the £2 million limit, where when you have assets above £2 million, it can start to reduce your residential nil rate band, which applies to your main residence. So
is your main residence exempt from IHT when passed on after death?
It can be. It depends upon the amounts. So the residence nil rate band is currently 175,000. It depends how you do it. So if the first spouse dies, leaves everything to the surviving spouse would also have their IHT allowances. So with the surviving spouse, as long as their estate's less than £2 million, they've got a £1 million IHT allowance. 350 grand of that is specifically residents' nil rate bands, £175,000 each. So in a lot of cases, it is possible to leave your home to direct descendants IHT free, but it does depend upon the amounts.
And Debbie just asked, what are the inheritance tax percentage rates?
So it tends to be 40% on almost everything. You do get the odd 20% one if you're trying to pass things over when you're living through trusts and whatever. This new agricultural property relief and business property relief from April 26, it's sort of bringing in a 20% band because you've got £1 million IHT free, which is 100% tax relief. Above that, you get 50% tax relief. So 50% of the 40% IHT payable.
Is there any issue with the private school billing a company for tuition fees and paying those tuition fees?
A private company can do it. It would tend to be a benefit in kind. It could be worth doing. You need to be careful in that the school fees are invoiced to the company and not to the individual. Invoiced to the individual and it's paid for by the company, then you've got NIC issues with that. Can have a bit of a saving. So a double cab pickup is classed as a van by HMRC. It's the van that's in the picture there. So you've got a double cab inside and a payload. Usually it has to be a ton or more on the back. So for benefit in kind purposes, it's classed as a van. And the benefit in kind for a van was just under £4,000. Whereas for a similar car, it could be 20 or 30,000. The company also able to reclaim the VAT. If you only use it for commuting and a very occasional private journey, you could escape the benefit in kind altogether. As from July 24, all new double cab pickups. It was in all the budget paperwork afterwards that they're going back to classing them as cars again as from the 1st of April next year. So this is for new double cab pickups. So if you've got an existing one, you're under the old rules. If you buy one before the 1st of April next year, you should still be under the new rules. But if you buy one after the 1st of April next year, you're then under the new rules.
Is commercial property buying and then letting to unconnected party classify as trading, business or investment?
It depends how active you are on it. So we're surrounded by commercial properties here. Some of it's empty, some of it's not. If you just buy one and let it out, that would still be seen as an investment business. If you've got a portfolio which you're hands-on managing, that's seen more as a trade. So just one commercial property that you're letting to different business wouldn't be a trade in my eyes.
How many is a portfolio?
It depends, because you 5 small ones, you could have a couple of massive ones. It can depend upon the time that you're spending in those. There's various cases with the tax office over the years. The name of one of them's just escaped me. I've got it written down that I tend to refer to. And the tax office do like taking these to tribunal because they do tend to win most of them.
Does the new pickup rate include if it's a lease?
For tax purposes, it would be. So a new lease after the 1st of April next year would come under the new rules.
And is that for new double cabs, so brand new from factory, or is it new to the owner double cabs?
It's new to the owner. So if you're going to get one before the 1st of April next year. So
isn't there something whereby if you like employ a family member, you can have something to do with their tuition fees? Is that university fees? I can't remember.
It's university fees. You don't tend to look at VAT on tuition fees, but it's whether it would be allowable for the company. And I've got clients where it's allowable because it's closely related to the job. And then we've got other clients where it's not allowable because it's not as close to the job as you want it to be.
Steve, if we could just kind of hand over to you as a very accomplished entrepreneur employing many, many people. This will affect you hard, a complex character as well, and understand so much of this. So over to you for your take on things, Steve.
Yeah, sure. Thanks, James. So I just really want to highlight 2 areas what really does impact on the commerciality of owning and running a business and requires careful planning. So the firstly is the big hit in the budget, which was the employer's NI. Just to cost to Nuvo, our FD ran the figures. £180,000 is the increased employer's NI cost to our business. other businesses will be impacted even more, especially when you look at combining the increase of the national insurance rate and the lowering of the limit together with the increase to the national minimum wage. 6.7% is the main national minimum wage increase. That's 21-year-olds and over. Those employing on the apprentice rate or the 18 to 20-year-old rate, the increase is up to 18%. So when you combine the increase in the national minimum wage and the national insurance hit, you get a compounded effect. So take the cost of employing somebody on the national minimum wage up to the end of March 25 is £25,800. From April, that goes up by £2,600 per employee. So 10.2% increase on the cost of employing somebody on the national minimum wage. So those businesses with high staffing costs, and especially with minimum wage employees, so we're thinking hospitality, construction, childcare, facilities management, cleaning, of which are going to have that increased impact compared to some other businesses. Just a worked example, so an £8 million hospitality business, so they're currently making 800,000 profit a year. The increased cost to them will be £300,000. So that's nearly 40% of their profit wiped out straight away from these changes. They would need to increase prices to their customers by 4% just to stand where they are from a net cash position. Or 11% price increases across all of their customers to be able to maintain their current margins. It's the same advice it has been before, but probably exaggerated with the changes that are coming in. You've got to be close to your numbers. You've got to have an understanding of where the business is, and you've got to plan in advance. These conversations need to be being done as soon as possible so that businesses can decide whether they're looking to pass the costs on to the customers, if not efficiency savings, to make sure that it doesn't just hit the bottom line. Which brings me nicely on to the second point, because if the hit in running a business isn't enough in paying additional taxes when you run the business, it's then the taxes when you come to sell the business. So again, the capital gains tax changes that Andy mentioned, not as bad as was expected. This whole expectation to align to income tax rates would have been absolutely horrendous for the being able to sell your business, but the impacts are far lower. They've kept the business asset disposal relief, which is really important. I think the impact is on the timing of when you sell the business. There was a rush. I was up till 3 o'clock in the morning last Tuesday getting a deal over the line before the budget because of the immediate expectation of tax changes. There is now increases at March 25, so there'll be another rush for businesses to exit by the end of March, and then again at March 26. So I think when people are looking at exit planning, you've got those 2 dates in the diary for when deals need to be done by to avoid the increase in tax. And the business asset disposal relief, which covers the first £1 million of selling your business, which is an attractive 10%, it's going up to 14 and then 18, which doesn't sound too bad. 18% is still a reasonable rate of tax compared to you sell your business before the end of March, you pay 10%, you wait 13 months later, you're paying 80% more tax. So timing is everything with people selling the business.
Yeah, and someone just asked there, realistically, how long does it take to exit a business if someone wanted to exit now before any future potential changes? I guess it depends on the size of the business, where you are. I'm a big believer that every business should always be exit ready, so you should always have everything in place. You're ready to be able to exit. When I sold my business, bearing in mind we're selling it was kind of a 3-month process to kind of line up the potential buyers, and then 6-7 months of due diligence that they wanted on that business. So you'd have to be moving very, very quickly. And the first thing anyone was going to want to see is the last 3 years of monthly management accounts. And it alarms me at how many businesses do not have those in place because you are not in a position where you can exit. So investing fully into the finance function of your business to make sure you've got those in place.
Yeah, well, the advice around it is just getting advice early, whether it's looking to sell your business around the capital gains tax rates, whether it's around the planning for what you do to mitigate the national minimum wage and employers' national insurance increases. It's all being close to your numbers, planning in advance, so you can proactively rather than reactively deal with these changes.
Yeah, I think it's really interesting because I probably look at some of the things that Steve and Andy weren't, well, Steve more so wasn't focusing there. We generally deal with individuals and families who are also business owners, but often they're transitioning the businesses within families, same as agricultural. I felt like a gut punch on my side about those coming in because historically that transition take a multi-generational farm, it could continue to exist and could continue to transition. Whereas now those assets, the business, those small businesses or medium-sized businesses, medium-sized farms now need cash to pay the tax just to continue. And that's something that's relatively new and people are going to have to adapt to. There's a good few questions about SIPs and SASs, and often in those types of pensions there's commercial property. They're not liquid. Commercial properties are properties, and so if you've now got to find a 40% tax charge on something that isn't cash, isn't an investment that you can readily sell, you're going to have to build up a war chest to be able to pay the tax liability or ultimately sell the property. When I'm dealing with, let's say, a family unit and it's husband and wife, for example, our primary focus is on making their lives the best they can be and protected, etc. And sometimes you have to refocus them that actually you're going to be fine. It's only the amount of assets that you can pass on that has now changed. You're good. Let's now look at how we can maximize that transition down the wealth generations. And short-term insurance for me is probably one that's jumping out as a stopgap to just allay people's fears. For a relatively inexpensive cost, you can probably insure against these liabilities to keep the business in your family, to keep the farm in your family, to keep the pension asset liability covered, and see what future governments do.
My rule of thumb now is a business should be investing between 2 and 3% of its revenue into its finance function. So we've got as much data as possible on up-to-date bookkeeping, monthly management accounts, forecasts, budgets, so I know exactly what's coming. So the moment anything like this happens, I'm not panicking. I can put different scenarios in with Nuvo and say, right, what happens if we do this? What happens if we do that? And the same with Dom as well. Okay, Dom, how has this affected us? What can we do? Should we consider this? Should we consider that? And I can hit Dom with questions on a daily basis, and he has the answer straight away, just because of how well invested we are in all of these functions. Thank you so much. This is something we're going to be doing very regularly now moving forward, making sure that our clients are armed with all the information they need